CFRA's Tuna Moby, Colin Sebastian of Baird, joining us to break down the quarter on what it turns out, guys, is looking like the best day for the stock since December of 18. It's good to see you. Tuna, what's your thinking on Amazon right now?
Carl, thanks for having me. I think just when some investors are started to count them out, they come out with this blow away, quarter. So I think the key here is to understand that the scale that they've built over the years in terms of their leverage and infrastructure is just starting to pay off. And this has been amplified by the shift to the one-day delivery. You look at the AWS division, there's several positive takeaways there. I know so much has been made about the competition from Microsoft, but I think some of those concerns are overdone. So all in all, I think the thesis remains really intact. As we look to the year, you may hear a lot more chatter about the antitrust issues that could create some volatility. But overall, I think that those earnings really had a lot of positive takeaways.
Colin, is it safe to say that Amazon now, with the rollout of one-day shipping on such a big level and all the money that's gone into those costs associated with it, that it's taking more market share from the traditional retailers who maybe before now had a leg up in terms of last-minute purchases?
Well, there's no doubt that one day is resonating with consumers, and that's pulling in more merchants onto the Amazon platform. But quite frankly, the strength in the quarter was the services side of Amazon's business. Those are the fees that they earn from merchants to sell on Amazon, the fees they earn from Prime membership, the fees from AWS. Product sales were essentially in line. Certainly one day helped mitigate any other factors impacting retail or e-commerce, but that was the beauty of the business model that was on display yesterday.
Yeah, Tuna, when I was looking at the AWS performance, it made me just reconsider what I was looking at across Megascale Cloud. When I heard Amazon, Microsoft, Google all talking about hiring salespeople, I thought maybe that's because the top line is slowing down and they need to invest to get more gas in the tank, but maybe not so. I mean, does this perhaps mean that they're just pedal to the metal, continuing through 2020? And I know you don't cover chip names, but it makes me wonder if the investment in infrastructure is more likely to continue throughout the rest of the year because demand is so strong.
John, I think the short answer is that those investments, I think you could see really proof points that those investments are paying off. If you think about the global cloud market, I think there's still a case to be made that we're still in the relatively certainly not later innings of that market. The addressable market is huge. That's why you see these top three providers, Amazon Web Services, Microsoft, and Google Cloud, all trying to zero in there because granted, you're getting a lot of margin pressure from these investments, but a case can be made. If you look at Amazon Web Services, for example, they're down almost 400 to 500 basis points from their peak margins over about last year or so. But when you fast forward and see the return that they're generating from these investments, the scale and how they're able to apply the new learning concepts, whether it's AI or machine learning, you get a sense that this is a huge ecosystem that still have a lot of runway ahead.